Hello, I'm Kirsten Spalding, your MC for today's 2020 Investor Summit on Climate Risk Digital Program and the Director on the Investor Network team at Ceres. Ceres is a sustainability nonprofit working with the most influential investors and companies on the greatest sustainability challenges of our time, including the climate crisis, deforestation, water scarcity, and inequitable workplaces. Before we begin today's program, I want to note that in the wake of the murder of George Floyd in Minneapolis, Ceres stands in strong solidarity with the Black community and the peaceful protesters who are challenging systemic racism here and around the world. As an organization dedicated to building a just and sustainable future, we realize that eliminating racial injustice is crucial to creating the kind of future we seek. Our hearts also go out to everyone affected by the ongoing impacts of the COVID-19 pandemic. We're especially grateful to those working so hard to ensure that we all stay as healthy and safe as possible. We're looking forward to working with our investors, companies, and policymakers in the coming months to ensure that we build back better from COVID-19 and support a climate-smart, sustainable, and inclusive economic recovery. And one of the ways we can do that is the focus of today's discussion: accelerate the world's transition to a net zero emissions economy. Investors are a critical piece of that work. I also want to thank each of you for joining us and recognize our summit co-hosts, the UN Foundation and the UN Office for Partnerships, and their generous commitment and support of our speakers and sponsors who've stood by us in this digital journey to reimagine Ceres 2020 and the 2020 Investor Summit on Climate Risk. We clearly wouldn't be here today without your essential support. Before we begin today's session, a few logistical notes. This session is being recorded. We'll be providing all participants with a link to the recording shortly after its completion. If you have questions, please enter them in the chat box that's located on your control panel on the right side of your screen. We'll do our best to answer as many of those questions as possible at the end of the session. And also please note, and we've already experienced it as we start this morning, there is the potential for global bandwidth issues. We may experience some challenges if this is beyond our control, and if it does happen, the discussion will pause for a few seconds to allow for bandwidth to readjust, and we want to thank you ahead of time for your patience in the event such an issue arises. I'm delighted to introduce the speakers for today's session, Climate Investment Opportunities in Emerging Markets. We have with us Dr. Ajay Mathur, Director General of the Energy and Resource Institute and a member of Indian Prime Minister's Council on Climate Change. We really look forward to your policy remarks and all of the insights you'll bring to this conversation. We have with us Faheen Aliboy, Managing Director and Head of the JP Morgan Development Finance Institution, a critical partner as we begin to move money in the right direction here. And then Babita Bisht, Deputy Director of the Green Climate Fund, referred to as GCF, an institution of the United Nations and a partner in many emerging markets. And then with us, Bertrand Millot, Chief Stewardship Officer of Caisse de Dépôt de Placement de Québec, and known as CDPQ, Bertrand, the real expert in emerging markets investment. Thank you so much. And I turn now to our moderator, Dazzle Bourgeois, Director on the Investor Network team here at Ceres. Dazzle.
Thank you, Kirsten. And hello, everyone. Before we dive deep into today's discussion, let me lay a brief context for why investors should look for climate investments in emerging markets. Today, more than before, institutional investors are seeking new growth investment opportunities to meet their unfunded liabilities. With a share of over 60% of global GDP, emerging markets are the world's primary drivers of global growth and wealth accumulation. But they are also responsible for about half of global carbon emissions. Many emerging and developing countries have realized that they are vulnerable to climate change and business as usual is not an option. As investors consider new opportunities in emerging markets, they must look carefully at countries' risk mitigating policies and partner with intermediaries such as development finance institutions, asset managers, and local companies who have deep investment exposure and experience in such markets. Countries like India, China, and many more are enacting ambitious environmental policies without compromising their growth prospects. These are the markets where global investors can look for growth opportunities as they increase their allocation to emerging markets and simultaneously reduce climate risk across their portfolios. Today, we have experts among us who will cover 4 broad perspectives. Number 1, how environmental policies are evolving in emerging and developing countries. 2, climate investment opportunities. Number 3, associated risk investors should look for when investing in emerging markets. And number 4, the role of public-private partnerships to steer the much-needed capital in projects where it has maximum environmental and social impacts. So let's get started. We will have 2 sets of questions for each speaker, and towards the end, we will have some time to take questions from the audience as well. And Dr. Mathur, we can begin with you, and maybe we can start with the policy aspect. COVID-19 has put the entire world into a tailspin. And as countries start to emerge from the pandemic and turn towards economic recovery, do you see the potential for emerging markets to move towards the path of green recovery and build sustainable economies? Over to you, Dr. Mathur.
Dazzle, every country in the world is today, after the economic lockdown that has happened, is today worried about 3 things: jobs, sustainable livelihoods, and economic growth. It therefore creates a wonderful chance to convince that green growth and these 3 goals are convergent. I would say it's not just, it makes sense, it's astute to do so. It is astute for governments and it's astute for investors. Why is this so? Because we are increasingly finding 2 things. One is that this does create sustainable livelihoods. These are livelihoods that will exist for decades to come and not be brownfielded out in 5 years, 10 years, 15 years. That's number 1. The second is that in emerging economies, there are growing markets. We have a lack of services in them, whether it's service for lighting or for cooling or for mobility, and these are underserved markets. The supply is short, and on the other hand, there is a huge latent demand as well. Consequently, as we introduce services, particularly green services, there is an expansion that happens, which then sustains itself and builds more of itself. In other words, it's not so much a question of changing the stock as it is in developed countries, in the industrialized countries, as it is about influencing tomorrow's growth. Thankfully, in all the packages that we have seen in the developing economies, there is room for equity investment in particular to flow into areas where green growth is now the growth of the future.
Wonderful. I think it's very clear, Dr. Mathur, that governments and investors will have to recognize shared needs and build partnerships to enhance, climate actions. Well said. Talking about partnerships, Babita, can you explain the unique role Green Climate Fund plays in building public-private partnerships to catalyze climate finance?
Great. Thank you. Thank you to Ceres, UN Foundation, and UN Partnerships for the opportunity to participate in today's panel. I think never have partnerships and solidarity been more critical than now, as the global community rallies to address the impact of COVID-19 and climate change with a view towards inclusive, sustainable, resilient communities and economies. In the past months, we've seen that climate change hasn't been under a lockdown. We've seen the devastating hurricanes in the Pacific, and we've all been warned of rising summer temperatures that's going to affect all of us. And yet we are at a critical crossroad. Oil prices are at the lowest. The risks of stranded assets is now a reality. And we have astronomical stimulus packages, about 10 trillion in the developed countries. And all of this is really an unprecedented opportunity to reinforce the link between people, planet, and prosperity, and to make the call that there is no trade-off between a healthy planet healthy economy, and healthy communities. And so for us from a Green Climate Fund, it's very simple. The climate crisis is too big, too serious, and too urgent to rely on the resources of public institutions alone. We need the finance and expertise of the private sector. At the same time, climate risks are financial risks that will affect everyone, but climate investments are also huge investment opportunities with good returns. And as others have said, the green story has the potential to be the growth story of the 21st century. And so let me just flag 5 key points specific to the Green Climate Fund. One is that we are a partnership-based organization. We are a partnership between developed countries and developing countries, where the fund was created in the context of the UNFCCC to promote a paradigm shift to help developing countries transition to low emissions, climate resilient pathways. We work with more than 150 partners at global, regional, national, and subnational levels. We have 95 accredited entities. This includes all the multilateral development banks like the World Bank, EBRD, African Development Bank. You have UN organizations like the World Food Programme. We have global, regional, and national commercial banks, private equity companies, and civil society organizations like Conservation International and WWF. And this is just to tell you the scope and spectrum of our partnerships is really critical to forge the radical collaborations that we need to see in this day and age if we want to drive transformative action. And from a private sector perspective in particular, this includes 40 entities with global brand names like Macquarie, Mitsubishi Bank, BNP Paribas, but also strong local players like Hasbank in Mongolia and other countries too. So we have a portfolio of 128 projects in 103 countries, which catalyzes about 19 billion in investment. And every single one of those is co-developed and co-financed with GCF, looking at public-private partnerships. Second is that we are capital agnostic. We are capitalized in grants by sovereigns. We have been capitalized at almost 10 billion for the next 3 years, and we can convert that into a range of financing instruments, grants, loans, equity, and guarantees, complemented by technical support and policy development, really helping partners in terms of addressing their unique investment barriers. The third is that we have a dedicated private sector facility to focus on private sector climate investments through concessional instruments, including low interest and long tenor project loans, equity investments, and risk mitigators such as guarantees, first loss protection, and grant-based capacity building programs. The fourth is that de-risking is a key feature of the fund, and this is so critical for public-private investments. We often hear that there is a dearth of bankable projects. For us, I think it's a matter of looking at the risk-reward profile and seeing and really working with partners to help make them investment-grade initiatives. We are risk-inclined, and this is a really important feature, and this really helps to close the deal. And lastly, we also work on the enabling environment, policy, regulations, plans, standards, incentives, policy incentives, which is also an important aspect in terms of, forging that collaboration with the private sector. And just to end, over the last 5 years, we've been in our startup phase. We have allocated about 5.3 billion to 103 developing countries with a co-financing of 13 billion and a total project value of almost 19 billion, covering both adaptation and mitigation, which is, I think, a really important point, Dazzle, that you made in the beginning, that helps countries to meet both the Paris agreements and the Sustainable Development Goals. And looking forward, we are now keen to promote transformative climate action, working with our partners, especially in the context of green resilient recovery, as we again work together to promote inclusive, resilient, and sustainable economies and communities. Thank you.
Wonderful. Babita, just a quick follow-up question in terms of the climate mitigation and adaptation. And if you could just mention about how GCF is supporting emerging and developing economies, especially post-COVID, or rather we are still in the middle of the pandemic, but in terms of how GCF is supporting countries as they develop their climate mitigation adaptation policies or strategies.
Right. One country, I think that there are a couple of ways. One is working directly with countries as they do their what is called the nationally determined contributions, NDCs, that all countries are expected to do in the lead up to COP, and seeing how we can help to include green stimulus measures, including recovery into that planning, because that's really the bedrock of climate investments. The second for us is, of course, adaptive management, because as I said, we have 5.3 billion already out with a range of partners. And how can we be flexible in terms of some of the implementation challenges that everyone is facing because of COVID? As we also look at, how can we ensure continuity of this financing and the kind of operationalization of the projects, because they are, it's about health, job creation, livelihoods diversification, all of that, which is really critical to economic recovery and resilience. And the third is that a bulk of our financing goes through projects. And so we're already working with our partners to see what are those transformative initiatives, promotes jobs, livelihoods, MSMEs, for example, and how can we bring in that range of financing instruments, equity, grants, and guarantees, especially for developing countries right now who have a high debt burden. They don't want to take additional loans or financing. And so being able to tailor that given the range of tools that we have at our disposal. I'm happy to go in more details, but this is like top line for now.
Wonderful. No, thank you. Let's move on about talking about investment risk. And Bertram, let's move on to you. Investors often find emerging markets risky. How does CDPQ navigate risk and opportunities in emerging markets?
Thank you, Dazzle. We as investors, we obviously see some great opportunities in emerging markets. There is a huge need for better infrastructure, whether it's transport, whether it's social, or whether it's sanitation, for example. So there are lots of opportunities, and these markets are growing. As you mentioned earlier, those are key aspects that are of interest to investors such as ourselves, long-term asset owners who are patient capital, looking for returns over the long term. Just to remind everybody, CDPQ is a pension fund. We manage 340 billion Canadian dollars invested across the world in all asset classes. We, however, in emerging markets, but actually increasingly in emerging markets as well, we see increasing levels of risk. And it's not just about COVID. Before COVID, we have all witnessed the rise of populism, authoritarianism, nationalism in various countries, including Western countries. We've also seen the rise of commercial tensions between countries, and all that affects the investment of environment quite significantly. In order to ensure that investors invest, we need to see some stability. And in infrastructure and all the aspects that I mentioned, the sectors that I mentioned, we need a stable regulatory framework. We need to see courts and dispute mechanisms that are independent from political interference. And we need to obviously see countries that are more or less stable at a social level. So that's very important. And the way we have approached this issue is to try to find local partners, domestic local partners who understand the environment in which they operate and who are able to provide a platform for us to help them grow their business. Examples of that would be that we financed renewable energy, for example, in India, using local players as a base, in Mexico as well, and are looking at other opportunities elsewhere. The opportunities that we see obviously are, in green energy. We're also involved in a number of partnerships with in real estate to build new efficient buildings. We see also opportunities potentially in transportation, although those are much more difficult to unlock. But what we need is projects that are being prepared by governments, and this is key. It is not our role to make public policy and tell a government, oh, by the way, we're going to do this. It's the government to decide, to tell us, we want the private sector to do this, and that project needs to be put together by the government and various agencies such as the multilateral development banks, the Green Fund, and all these other actors, so that there is something for us to invest in. These projects, it's not our role to do that. And I think also a very important factor is that we're investors. You know, there is huge social issues in the world. There is huge levels of inequalities. Unfortunately, it's not, we're not equipped to do that. We're looking for a return. Now, the projects that we invest in will reduce these. Providing public transportation is a public good. Providing cheaper electricity is a good thing, etc., etc. But if the government, for social reasons, needs an element of subsidy because there are some groups of people who need cheaper access to services, then that needs to be structured at arm's length from the private sector. The private sector cannot be doing that. It's not our role. And that is, you know, when we talk about public-private partnership, there is a role for the public sector. There is a role for the private sector. And those two needs to be very, very clear. Otherwise, if you start mixing this, then the signals are mixed. That increases the risk very materially and makes the projects difficult to invest.
Oh, absolutely. And I think stable policy environment makes all the difference in giving the confidence to the investors. And investors often try to look emerging markets in under one block as a risk category, but it's important for them to look at country by country, understand the policies and on the underlying risk before they move forward for investing. Wonderful. Fahim, JP Morgan, launched their own DFI earlier this year. How do you see JP Morgan differentiating its DFI from other DFIs to meet its clients' risk and return expectations? And what are some of the strategic initiatives that JP Morgan plans to undertake through this DFI?
So good morning, good afternoon, and I am very pleased to be here, and thank you to Ceres for this initiative. So the JP Morgan Development Finance Institution was launched at the end of January, so we've been up and running for just about 4 months. And I think the impetus here is really to bring development finance to the capital markets. I think the traditional DFIs, and I come from a very long career of 18 years at the IFC, both those DFIs focus on the public or private sector are buy and hold investors. They give either loans to governments or loans or equity investments in private companies to have both to have a development impact. And I think what JP Morgan would like to do is really focus on what its strength is as a sell-side financial intermediaries, which is to help clients raise money and help investors such as CDBQ allocate their investments to good transactions and to bring those two together. And this DFI would like to do that, right? To help in that effort, to help issuers raise money in the capital markets, but to put a methodology behind those use of proceeds and make sure that those use of proceeds actually have a development impact. So we have developed in partnership with the traditional DFIs. We actually went and showed it to them. We had someone seconded from one of the DFIs to help us develop this methodology. And it has a development intensity score. It maps actually the outputs to the SDGs. So we would like for each of the transactions that the DFI at JP Morgan is involved with to be put through this methodology and let investors know where that money is going. And it allows issuers to signal to the world that they care about the impact of what they're doing. So I think that's the difference, taking it to the capital markets and applying a rigorous methodology behind it. I think the impetus of this DFI is exactly what you said, Dazzle, that so much of the world's GDP is coming from emerging markets, big and small, and that's a continuing trend that JP Morgan sees and wants to be a part of. And the second is that investors care more, right, about what they're investing in, be it climate, be it sustainability, be it development impact. And so we are responding to that. From a risk return profile, this should not change. The JP Morgan DFI is a commercial venture, and we are hoping And we will do transactions that are commercially viable, that go through all of the typical screens, but yet give investors that comfort that they would know what those monies are being used for. With respect to strategic initiatives, I think some of the things that we're thinking about is they're not brand new, but how can we grow them? Things such as gender bonds, diaspora bonds. How do we kind of make those more viable? And is there a way to have a more systematic way to use risk mitigation products to make deals happen, as others have mentioned? So I think the ultimate goal of this DFI is to make development finance actually a traded asset class. Can we do what the green bond market has done over the past 5 or 7 years and actually have investors say, okay, this is development finance, there's a methodology behind it, and we want to bring our money to it because of the impact it's going to have. So I'll leave it at that.
Wonderful, Brian. I'm going to follow up with you once again on the impact aspect that you mentioned. But before we move on to talk about investment opportunities and their environmental and social impacts, I would like to remind our audience that if you have any questions for our speakers, then please type them in the chat box in your control panel. And maybe we can start with our second round of questions. And Dr. Mathur, we can once again come back to you and start with you. As India rolls out its planned policies and stimulus package to revive its economy, what are the biggest climate opportunities you see in India where public-private partnerships can be leveraged?
Well, I think there are a couple of areas where we need strengthening and acceleration of these partnerships. Batra mentioned of CDPQ's investments in renewable energy in India. And that's one of the sectors which is growing and growing very fast. And why is it growing? Because we have reached a price point where electricity, round-the-clock electricity from renewables plus storage will cost less than coal electricity. The recent tenders in the last couple of months have shown that this would be delivered in about 3 years. Now, obviously, this means that there is a sharing of risks with the government coming in, and in the successful projects, they have created the land areas, got the power purchase agreements, in some cases even got environmental clearances, and then bid out the project. So depending on where and what kind of project it is this de-risking partnerships which are important. Since the growth is going to be in renewables plus storage, clearly batteries is another area where these kinds of investments make great sense. As of today, all the battery making in India is based on consolidation of the cells. There is very little cell making that occurs in. That's a huge opportunity waiting for investments to come in. Other areas where there are opportunities include the small and medium enterprises, where there is a range of energy efficient investment opportunities that occur. Waste heat recovery. Again, technologies that are relatively well known but have to be suited for the scale. Again, it is de-risking that matters. As part of the economic stimulus packages, the government of India has, for example, put together risk guarantee funds for these kinds of investments, because clearly in the small and medium industry sector, the ability to collect the resources to get that money in requires a certain degree of confidence, which I think the guarantee funds would enable. On yet another side, we see new opportunities. We see hydrogen is coming in as a major fuel in the future to replace fossil fuels. Well, if hydrogen has to come in and be competitive, we'll need very efficient electrolyzers. There is investment needs for the manufacture of electrolyzers. So again, power purchase agreements matter. What also matters is if you're coming into the manufacturing, whether of batteries or of solar cells, that should sell. How do we make sure that it sells? We are looking for government, the public part of the public-private partnership to say, for example, that in the procurements, in the tenders, there would be a certain part which would be devoted to manufacturing, which has been done in India, irrespective of where the investment came from. Those are the kinds of opportunities that I see developing. Obviously, there'll be a lot more, but solar pumping, so the agriculture sector, and moving away from fossil fuel-based pumping, whether it's electric pumping or diesel pumping, to solar pumping, that's an area where a huge government program has been rolled out and where investment is being sought for the manufacture of solar pumps, which can feed into this large program that has been rolled out. In other words, what these programs do is provide the basis for investment in this sector and for a risk sharing, which allows investors to be more confident of coming in to provide particularly the equity capital that is needed.
Wonderful. And it is well known that India is well known for its deployment in renewable energy and energy efficiency projects. But I hear you that there is a huge potential to seize opportunities in sectors such as agriculture, waste, decarbonizing industry. You gave examples of solar pumping and EV transition. That's great.
And the small and medium enterprise sector.
Absolutely.
So, to follow up, Dazzle, I've been working very closely with an investment institution which invests in only projects which are green projects, low or zero carbon, but where the returns meet or exceed market returns. Mm-hmm. They've already invested $1 billion, and they expect that their second billion would be invested. The first billion took about 6 years. They expect the next billion to be invested in about 3 years.
Yeah. And I think it's getting more and more evidently clear that there are opportunities which are commercially viable and generate market-based returns. The concern remains, and the question that investors often have is the impact of such investments. And Fahim, maybe I can come back to the point that you had mentioned, that investors who invest in climate and developmental investments would like to show and articulate impact of such investments. How does JP Morgan measure such impact?
So I think, Dazzle, I fully agree. I think investors are becoming more vocal and clear that they have climate, social, and development impacts that they hope to achieve through the money they're deploying, as well as having the commercial return that we've all spoken to. And to do so, I think they're asking for clearer frameworks, reporting, and standardization, because it's much easier to follow that money. And I think the standardization, which I don't think we're there yet, is going to be the key in the medium term. I think in response to such investor demand, JP Morgan, it set up a climate team several years ago, and I think it's been very active in the green bond space. There are now ESG linked indices available. JP Morgan and many other banks have things of that nature to help guide investors on who's doing well on frameworks. And there are now third-party verification systems in the climate space to actually track whether the investments are doing what they said they would, and that clients and banks are using those to measure the impact. And there's some even pricing differentials that happen when certain targets are not met. So I think this is all part of, as you said, measuring the impact. As I mentioned before, the DFI at JP Morgan, before it was launched, came up with this development framework and methodology. And it was presented to other DFIs and at the Center for Global Development. And I think another big important thing is transparency. So this methodology we put straight on the website for others to see and to make sure that investors and clients would know what are the things that we're looking at. And with respect to this methodology, and I'll bring it directly to climate, the things that we're looking at is that we're screening away certain sectors. So It will not be a DFI deal if there's coal, for example, amongst other sectors. We will endeavor to use all environmental and social, JP Morgan's environmental and social standards for any deal that would be DFI eligible. And if there is a positive climate impact, doesn't matter what the deal is, it could be with a financial institution, it could be manufacturing. If there is any positive climate benefit, the score is higher, right? So I think these are ways that climate has been incorporated in these methodologies, but overall, it is just important that we have the frameworks, there is reporting, there's transparency and standardization.
Yeah, no, that's true. That today there are standards available out there, and the more transparent institutions get in terms of showing and articulating the impact that they are generating through these investments, investors' confidence is generally going to rise, from here. Babita, Dr. Mathur mentioned that there are several opportunities out there, but it's also a time where de-risking capital is provided. Can you share some examples where Green Climate Fund has provided catalytic capital to de-risk some climate investments, and what were the likely impacts of these investments?
Right. Thank you so much. So I'd like to provide two examples. One is mitigation focused with adaptation benefit, and the other is adaptation with the mitigation benefit. Again, this just trying to make the point that we need to look at both, and there are really good investment opportunities in both. So one is a project, renewable energy project in Chile. It's a $1.1 billion project done by a local energy developer, Valhalla, and the Mitsubishi Bank, which is one of the biggest global banks. So the background is that this is a large-scale project that innovatively combines Chile's natural resources with the proven technology to provide renewable energy 24/7. It's a pump storage hydro project. For those who know the technicalities a little bit more on renewable energy. And the water is pumped from the Pacific Ocean using solar energy, and the water is stored to generate hydroelectricity, which again is what generates the 24/7 baseload energy, addressing a key challenge of renewable energy, which is its intermittent nature. And the water is also desalinated to provide drinking water to the community. And this is a large-scale project, and it will really accelerate the shift to clean energy and decarbonize the national grid by up to 5%, contributing to Chile's goal of renewables accounting for 70% of the country's power by 2050. So that's the project. So in terms of GCF's role, we were able to, again, launch a game-changing initiative that might otherwise be unbankable by underwriting high project risk in the absence of other investors. We made a 60 million anchor investment in the project's equity prior to having a power purchasing agreement in place, which is a big step. And so by doing that, we helped to de-risk the project and unlock some of the financial barriers. And this has enabled the energy developer to complete development. This will also help them to put a PPA in place and attract other investments. And our investment is expected to catalyze significant financing in private equity and debt, with every dollar invested by GCF projected to leverage an additional $18. This is senior loans, equity, and other forms of finance. So what we were also able to do, and this links to my earlier point on the public-private partnerships and bringing a range of stakeholders together, we were also able to work with an unprecedented collaboration with diverse partners, a local energy developer and Mitsubishi Bank, which is, again, a big bank, so which is unique and in a sense provides a roadmap of how we can also shift trillions in private capital towards low carbon climate resilient economies. And this project in particular can also be scaled, particularly in Africa and Latin America. So that's the renewable energy focused project. The other project I'd like to mention is with Acumen, which is an impact fund. The Acumen Resilient Agriculture Fund is the specific initiative. It's agribusiness focusing on Africa. And the background is that smallholder farmers make up a majority of the poor, and the weather-dependent livelihoods and lack of safety nets make them highly vulnerable to climate change. And climate resilience is key to ensuring long-term sustainable increase in agricultural productivity and incomes for smallholder farms. The project is designed to shift investments in adaptation activities from grants to long-term capital, so a financing perspective, and enabling smallholder farmers to respond to change more effectively. And ARAF, which is the fund, actually supports entrepreneurs in micro, small, and medium-sized enterprises in Ghana, Kenya, Nigeria, and Uganda by providing farmers with innovative financial services, including micro-insurance and mobile payments. And this is a project, I think, totally 56 million. We de-risked it by providing 20 million in first loss equity and an additional 3 million to strengthen the investees' business models to provide climate adaptation products, services, and training to smallholder farmers. So these kind of give you a sense of the kind of investments, the transformative nature of some of these initiatives, because I think for GCF, there are many other funds out there. What is it that you can do with GCF that you can't get it done with the others? I think that's one of the kind of key parameters. And going forward, especially in the context of COVID, we'll be looking at, again, very transformative investments, jobs, livelihoods with strong environment and development co-benefits.
Excellent. These are excellent examples, Babita, both for Chile as well as in Africa. Moving on, Bertrand, emerging markets, and as we hear, are urbanizing at a faster pace than developed markets. And they also face a growing need to renew or build infrastructure that is resilient to climate change. How can institutional investors participate in this growth story and simultaneously mitigate systemic risk posed by climate change?
Well, as I explained earlier, there is the renewable energy. I think is the easy one. Not that it's easy, but it's the easy one, provided that there's supporting framework for power purchase agreements, et cetera, so that the projects can be structured properly. I would say, with as you mentioned, the questions of urbanization is a critical issue, and we all know too well the traffic jams in all cities, but in emerging markets in particular. So we would see a need for large investment in public transport. We haven't to date done such investments in emerging markets, but we certainly are in developed markets. We are developing a 67-kilometer greenfield rapid transit in Montreal here. We're also looking at other opportunities of that nature in the Asia Pacific region. We're doing that in equity, and in debt we're financing a number of rapid metro systems across the world. We're also quite a large shareholder in an entity that manages rapid transit systems and public transportation on behalf of cities. So, it's the type of thing that we wish we could see more opportunities of in emerging markets, but obviously then I come back to what I was saying earlier, the questions of project preparation and how are those investments structured. And the key question is, governments often say, well, we can't involve the private sector, this is a public good. Well, yeah, but then you don't have the money to do it, so you need to make a decision. And the private sector is prepared to put money and build, put money on the ground and build, but the framework needs to be there.
Wonderful. And I see that there are plenty of questions coming through from our audience. And there's a question for you, Dr. Mathur. What learnings can governments and investors take from the 2008 financial crisis as they chart the path of recovery from the pandemic?
Well, there are two lessons that I think are particularly important. One is that public investment and public directions for investment are essential. So there have to be a number of interventions which help direct investment into a particular jurisdiction. The second is that at the height of the crisis, when people are hurting, cash transfers are important. Now, obviously, in emerging economies, the amount of fiscal space that countries have is relatively limited. The amount of cash that they have is relatively limited. But whatever is the amount of cash that countries can put together needs to be provided for the immediate relief, as well as directional goals to help the future investment, and an intermediate stage for recovery of those companies which suffer because of lack of demand, because of the fact that they have to lay off workers, in the current COVID crisis because workers could not come to work. But those are the people who hurt. Those are the companies who hurt. So helping them is important, and then providing the kinds of directional risk-sharing measures which helps invest capital into the areas where they expect that jobs, sustainable livelihoods, and economic growth will occur. We learned this in 2008, but we also learned it in 1929 when the Great Depression happened.
Yes, wonderful. Fahim, would you like to add something to what Dr. Mathur said on this?
No, absolutely. I think what the key learnings, and we're still in this, right? So we're still learning, is how do we do better contingency planning, right? This is something that not all countries are great at, or even in the U.S., different state and local levels, etc. And it's from a health basis, right? So some countries have done much better in a health response, but not on the economic response. So how do we look at all aspects of the impact chain, I would say, and have a backup plan? It's also how do we take health risks and climate risks into national planning? I think this is something that we've all known about, and simulations were done, but now that it's happened on the ground, how can we take real learnings and say, how do we do that? A simple example is technology, right? And who could benefit from using the internet and being home. Those are people obviously who do not work in the informal sector and have to go and earn a livelihood every day to eat that evening, right? But who, even others, they went home, right, because they could, but then because of poor quality of internet, couldn't continue working. And those that could, so I'll just give a very anecdote. We just moved back from Senegal, and my children today are being tutored in both math and French with people sitting in Dakar. And that's possible, and those two people are earning an income and providing a service because of good internet that the country has in certain quarters. So I think that's an interesting way of learning and takeaway from the crisis. And finally, we have to think about not only new ways of working, but living, right? So some of that infrastructure investment, how do people move around in the future? And finally, how governments and the private sector work together to solve these problems, because they're the two different legs of the economy.
Absolutely. Thank you. Babita, I see a question for you over here. How does GCF identify investment opportunities, and can investors get in touch with GCF directly?
Okay. So indeed, can investors get in touch with us directly? Absolutely. On our website, you find all the contact details of teams, sectors, regions by country, but also our private sector facility colleagues, PSF, and they're very engaged and open to collaboration. Again, our interest is again looking at transformative investments. Transparency is really key to us, and so you find actually everything on GCF is online: funding proposals, project documents, and more. And our board meetings are also live, so you can actually see the decision making on some of these high impact, high value projects. But stepping back, a key principle for GCF in terms of the investments is that the principle of being country driven and country ownership. I think Bertrand's also mentioned that in different ways. And we engage at a strategic level with countries to identify priorities and investments in terms of their long-term ambitions through country programs. And again, I really want to flag the importance of the nationally determined contributions that all governments are supposed to do to be updated and submitted to COP. And that kind of is the backbone for most of us looking at investments and how aligned projects and priorities are. And then, of course, GCF has leads in the government, whether it's in the Ministry of Finance or Ministry of Environment, which is really important going forward. Then the other part is then we have the 95 project partners who are really critical to identify, originate the projects and the specific investments, and that is then shared with us. But three quick ways I can flag already for the private sector is: one is co-investment, particularly important, I think, for institutional investors and others looking to invest in real projects already. We have either of our projects is already up and running that I'm sure would always benefit from co-investments, from a pipeline, which is well over 10 billion. Second is one can be an executing entity where we can match you to a partner who is already accredited to us. For example, in India, we matched Tata Cleantech Investment with NABARD, the National Bank for Agriculture and Rural Development, because NABARD was accredited to us. And this was a rooftop solar financing project where Tata Cleantech was able to access 100 million from GCF through NABARD. So that's another way, for example. And the third one, which is a little complicated, but again, this is where the bulk of the money flows, is through accreditation, where entities and organizations apply to become accredited to the fund. You also need to demonstrate whole set of safeguards, class-leading standards, gender, ESS, all of that. But that's also how BNP Paribas, Mitsubishi, but also private equity firms like Pegasus and all have been accredited. We hope to make that simpler, but again, rounding it off, these are three different ways that we could look at how we work with the private sector and others.
Wonderful. I see here one more question coming in, Boshra, that's pertaining to you. As investors aim for net zero ambition by 2050, how do you see investors positioning emerging markets as part of their climate action plan?
Well, that's an easy one, thank you. The good or bad news is that concentration of CO2 is the same everywhere, and that climate change is an issue for everybody at the physical level. So we make no difference in our policies, whether it is emerging market or developed market. Just a quick reminder, the Net Zero Asset Owner Alliance is predicated on pushing the economy, global economy, towards decarbonization. So that includes just about everybody, big emitters as well as small emitters. And the key ethos there is the realization that if we're going to divest, well, that asset that we're divesting is going to continue to pollute, doesn't change anything for the planet. And so, and also, because it doesn't change anything, it doesn't shield us from climate risk later on, because the planet will not be decarbonized. So the only solution is to really decarbonize the industrial sector and other sectors to the extent, well, the ones that are pertinent to investors that we can act on. And so so those goals apply to everybody. Obviously, there are two levers to do that. There is investing in green assets and transition, or if not green, less brown or black, at least for the time being. Let's not forget that this is not going to happen overnight, so some transition needs to happen. And people need electricity today, and better gas than coal, but preferably green, but one thing at a time. And the other is to actually push the entire economy to reduce emissions to the extent possible, and really make the effort. And this is, again, it's something that everybody needs to think about, whether you're an IT company or a cement producer. The pathways would be different, but it needs to be done. And so we as asset owners engage with companies in the portfolio on a repeated basis to actually push them to make these investments. And if these investments require large amount of capital, then we obviously can provide some as well, some additional capital as required.
Wonderful. I think we are coming close to the hour. Maybe we have a minute or so. Dr. Mathur, there's a question which has come in for you as well, and maybe if you can keep it a little brief, though it's a very broad question. That Indian Prime Minister Modi has set huge targets for renewable energy, 175 gigawatts of renewable capacity by 2022, and 450 gigawatts by 2030. What advice do you have for global investors interested in exploring these opportunities?
It's a great opportunity. We've already seen that the price of electricity from renewables plus storage is cheaper than the price of electricity from fossil fuels. This is the growth area. Yes, there is a downturn. It's a 2-year hiatus But after that, the growth will start again, because at the end of the day, India is a country which uses probably 1/4 the amount of energy that it would ultimately. The demand is there, the green technologies are there. We need to accelerate the process. Investors, this is the opportunity you've been waiting for.
Absolutely. Thank you very much. So before we conclude, I would say one can take three broad takeaways from this session. Number one, policymakers should create non-partisan policies that builds markets and clients. Owners should review their asset allocation in emerging markets and make necessary changes if need be, so that they don't miss out on the biggest investment opportunities emerging from some of the biggest growth markets today. And for DFIs, it should look for projects that are more commercially viable with environmental and social impacts. As Babita mentioned, that every $1 of grant can potentially leverage $18 of private capital, and that's a significant leverage. So with this, I would like to thank all our speakers and attendees for taking part in today's session. Before we adjourn, I wanted to thank the 2020 Investor Summit on Climate Risk co-host series, the UN Foundation and the UN Office for Partnerships, and the sponsors that you see on your screen who have provided instrumental support for today's program. Please note, you will receive a follow-up email with a recording of the session shortly. I also wanted to invite you to Series 2020 closing session. The time is now to build back better on June 25th at 12 p.m. Eastern Daylight Time. To register, please visit website series2020.org. Thank you. This session is adjourned.
Thank you.
Thank you.
Bye.
Bye-bye.